Well, hello everybody, welcome back. My name is Alexander Nikitin. I'm a professional trader and a developer of pattern search software. And in today's video I will talk about the original Gartley pattern. And if you watch this video till the end, you will be amazed how the original pattern differs from what we have right now, nowadays. Okay, let us start then. It all starts from the book of Gartley. This book is called Profits in the Stock Markets. So it looks this way. The blue cover. Here is the Gartley, 1899-1972. So here the book, Profits in the Stock Market PDF. Let's go to the page that describes the Gartley pattern. It is page 222, and we have figure A and we have figure B, figure 27 part A and part B. And before I continue with that, before I read the explanation of that is given by Gartley himself, before I do that, I first need to remind you the basics. Gartley bases his views on Henry Dawes theory. And the Dawes theory says that prices move in trends, and that the trend is a series of peaks and valleys. If we have a series of ascending peaks followed by ascending valleys, this is called an uptrend. If we have a series of descending peaks followed by descending valleys, it is this series is called a downtrend. Let me draw it. This is a peak. Why we call it a peak? Because price on the left and price on the right are lower. Those prices are lower than the price of the peak. And this is the valley. Why we call that a valley? Because price on the left and price on the right is higher than that. So this continues. The series of higher peaks. So we have one peak, another peak, another peak, and followed by higher valleys. So we have valleys. When we have this means that previous valley was broken. So instead of higher valley, we have a lower valley. Compare that. This valley and this valley. Obviously, this one is lower than previous. So this movement breaks the previous series, and it is called that an uptrend has stopped. So starting from that, we can have one of two things. We can continue lower, thus we will give a downtrend, or we can continue higher, thus we will start a new uptrend. It is not the same uptrend, but it is a new uptrend. The first one was stopped by this movement, and then new uptrend has begun. Typically we start a new downtrend. Typically it is, I don't know, 60 to 70% that we will start a new downtrend. At least some minor continuation will be. If we break it this way to the upside, this means an uptrend has begun. Okay, so once you know what is the trend, how to identify trend, when the trend is over and when the next trend has begun, then you should understand the fractal nature of trends, of movements. So this means that inside of intermediate trends we have minor trends. What I will draw here, I will draw an intermediate trend, and this red is actually a minor trend, like this. If we continue that intermediate trend, let me zoom it out more and more, like this. Continue this intermediate trend this way. Then we'll break that trend and start moving lower. And then we have another trend to the upside, moving higher. So guess what we have? Here we have what is called a major trend. And let this major trend be black, and let me draw it this way. So this is the major trend. You see, minor trend is a part of that intermediate trend, and intermediate trend is a part of major trend. Keep in mind that terminology, because when we will read that, you should understand what we are talking about. So these are the basics. Let's go back to the explanation. It is called one of the best trading opportunities, blah 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 blah, not interested here. With small, let us look at figure 27a. So when after an intermediate decline in either a bull or bear market such as A to B in the diagram, so this is intermediate decline. Remember what is an intermediate decline? Intermediate trend. It is the same, intermediate decline. 1, 2, 3, 4, 5. So it should be the series of lower highs and lower lows. Intermediate decline, such as that on the diagram, like this. Let's go next. Has proceeded for some time and activity has shown definite tendency to dry up. Activity has shown definite tendency to dry up. This means that the volume becomes, as price moves here, the volume of that becomes smaller and smaller and smaller. Less contracts are bought. As we go to B point, less and less volume becomes lower. This means that activity is drying up. Indication that liquidation is terminating. A minor rally like BTC sets in with volume expanding to the upside. So we first need to break the previous low, thus we will stop that previous downtrend. And this breaking should be accompanied by a large volume, expanding volume. So we have volume declining, and then we should have volume expanding. Let's draw the same picture in our trading view drawing tool. It should be intermediate. We decided intermediate to be blue. So we have that decline, and then we have the rally to the upside. During that decline, if you use on balance volume is a quite good indicator for you. So we should have something like this. Volume is declining, and then you have it expanding like this. During this phase, the volume expands, and it doesn't matter if it is inverted. You have an uptrend followed by this downside break. The volume will stay the same. It doesn't show the direction of a trend. It shows that number of contracts. Okay, so let's continue and drawing next. With volume expanding to the upside, on the upside. And when a minor decline after cancelling a third to a half of the preceding minor advance, cancelling a third to a half means that retracing a third to a half. So we should first draw that. I already prepared that Fibonacci retracements. Oh, sorry. It's a bit large. This is third, 0.3333, and this is half. So we should have a minor decline. How do we know that decline has stopped? That it is third to half. Does it stop right now? No, we don't know it. So to know that, we need to have a valley. So we need to have minor movement to the upside. So we definitely will say that this valley is in the zone of third to half. If we don't have this valley like this, yes, so movement goes there, here, and that won't give us the criteria from third to half, or it moves here like this. You don't know it yet until you have that valley. So just wait for price to bounce off that area from third to half, like this. And it is drawn on the diagram as well. we have decline, and then we have started some movement to the upside, so you obviously understand that this is a kind of valley. Let's continue next. Preceding minor advanced BC with volume expanding on the upside, and when a minor decline cancel in third to half of the preceding minor advance of BC comes to a halt, with volume drying up again, a real opportunity is presented to buy stocks with a stop under the previous low. Let's go here. So when you have this movement to the downside, that is a third to half, the volume should drop. It should move lower back like this. It should go to the downside. So here will be your stop loss below the previous low, as Gartley has said. So the selling zone, the buying zone will be looking this way, starting from that half, 50%. This will be your buying zone. So the next time, maybe from here, it doesn't matter from where this valley is. So starting from here, if price enters this zone, you wait for buying opportunities. Let's read further. In 8 out of 10 cases wherein each of these specific conditions occur, a rally which will provide a worthwhile profit ensues. I will just explain what is the worthwhile profit. In other 2 cases, only small losses have to be taken in trading this formation. The observer is depending upon the probability that either a head and shoulders or a double bottom, which are the 2 reversal patterns will occur most frequently, is developing. The art of conducting an operation of this kind lies in. I will read it further. Okay, so actually what it says, that we are looking at either a double top or a double bottom of a major trend. So it's very important. Like this. This is a major trend. Remember, blue is intermediate trend, and this is the double bottom of a major trend. This is the second bottom. So if you combine it with volume, if you combine it with breaking that structure, yes, if you combine that with zigzagging formation, if you combine that with Fibonacci, odds are in your favor that you will have that double bottom. So what is called the worthwhile profit? It is actually this. If you trade double bottoms like this, yes, the standard way of trading double bottoms is this. You wait for a break of that, then you wait for a retracement back to neckline like this, and here you enter after the retracement to the upside, and your targets are actually the size of that double bottom like this. This is your target, and then you go to hit them. Actually, typically the double bottom is traded this way. You wait for that break, you wait for a retrace, and this is your target of that, of the height of that double bottom formation. This is your break. What Gartley supposes that you can start that double bottom without waiting for that break. If there is volume, if there are ratios, and there is zigzagging theme, you can find the entry here, lower, almost at the bottom of that double bottom. And if you enter here, just imagine here, yes, let's measure risk to reward. Those standard targets and this risk below that double bottom. 4 to 1, risking 1 to generate 4. Okay, here's the worthwhile trading opportunity, and it works 8 out of 10, but it doesn't present always. You need to be patient, checking them every day. Okay, the second variation that Gartley says that it can also be not a double bottom but a kind of head and shoulders formation. Yes, it can be. It can be as well. So it looks this way. This is the neckline of the head and shoulders, like this. This is the left shoulder. This is the head. This is the right shoulder. Right shoulder. This is the break of neckline, the retracement, and so on and so forth. So once again, left shoulder, head, right shoulder, and break, and so on. And the head and shoulders are traded the same way from the point of break, or I don't know where it should be calculated, but typically it is the size of the head. The size of the head. Then it should be projected to that breaking point. Targets are the same, so you will have the same opportunity. So somewhere within this zone you are looking for entry. Let's read further. The art of conducting an operation of this kind lies in having the patience to wait until a decline of substantial proportions has developed. So you need those proportions, you need those decline, and you need to wait, and you need to be patient. Second, observing that all conditions laid down are present. Yes, you need all conditions. Then you need having the courage to buy just as soon as the minor reaction which tests the bottom shows signs of terminating. Here, let's say this is the minor reaction, and you need to see signs of termination. And here in that signs of termination is what is called minor trend identification. So these are the signs of termination. Let me draw it this way. Oh, possibly I can't draw it this way. Okay, you know that those swings are actually minor trends. Remember those red trends like this. So this is actually a minor trend. It moves this way. It doesn't matter. So breaking this will be the sign of termination. Sign of termination of that swing to the downside, and it is actually the sign of termination, the whole double bottom formation, or right shoulder of that head and shoulders pattern. So what Howard-Gartley provides is the opportunity to trade double bottoms and head and shoulders, and you don't wait for the break of the neckline as typical, but you can trade them closer to high, closer to low in case of buying opportunity. And you can see it is very much different from what we have right now. Nowadays we are looking at some ratios, and we draw the pattern regardless of the structure. We draw them regardless of volume. We only look at the Fibonacci ratios and blah blah blah. When Howard-Gartley invented that pattern, he was thinking of double bottoms and head and shoulders. So you should think of them as double bottom and head and shoulders. And consequently, yes, if you are looking at that Gartley pattern, you should find a bullish pattern in the end of a downtrend, and you should find a bearish pattern in the end of uptrend, like this, in the end of uptrend. So you see that 50% retrace, then you see the canceling movement. It doesn't matter if this movement is straight or zigzagging. So this is X to A to B to C, and then you wait the D point to complete somewhere here, and the sign of completion is that break of minor trend. Let's look for that other things. And number 4, you should have the courage to get out with fair profit, 10 to 20%, or at least protect it with stops. And then he explains hourly charts of the average available for guiding the operation, repay the market students for all the efforts he puts into keeping the day after day when they are of less practical use. So you should you won't have those setups every day, especially with this volume and those ratios, those zigzag informations in the top or in the bottom of the uptrend. You won't have them every day. Too many conditions should meet. But if you meet them, 8 out of 10 will win. And in 8 cases you will win 4, and in 2 cases you will lose only 1. 4 to 1 risk reward. Keep that in mind. Probably you will only trade that setup. Probably. You will do the backtest and only trade the setup. Let's read next. Similar opportunities occasionally develop for that small part of the trading fraternity which has the intestinal fortitude and temperament to sell stock short. So he's explaining that this is similar to buying. If you buy or sell, it doesn't really matter. The case in reverse is laid in section B of figure 27. An excellent case in point on the bull side appeared on the March 35, see chapter 7, particular chart 11. So it is very far from here. Okay, that's it, guys. Hope you like the original Gartley, how he's treated. It is a reversal double bottom or head and shoulders pattern, and you can enter that double bottom or head and shoulders pattern earlier than everybody else. You can predict that it will be a double bottom or a head and shoulders. If you pay attention to minor trends, intermediate trends, and major trends, if you pay attention to volume, if you pay attention to third to half ratio, well, that's it. Hope you like this video. Hope you have a bit better understanding of the pattern that Gartley was talking about. Maybe it will help you, maybe it will change your trading. Until then, good luck, good trading. Hope to see you soon.